If you're between 20 and 40 years old, this video is for you. We're in a unique phase of life. We've got some income, a lot of time ahead of us, but also a ton of responsibilities and maybe even some debt. And everyone, absolutely everyone, is telling us to invest. But what does that even mean? Where do you start? It feels like you're supposed to be a stock market genius overnight. Well, let's cut through the noise. This isn't about getting rich quick. It's about building a solid financial foundation so you can actually enjoy your life now and in the future. So before you download that flashy trading app, let's talk about the 5 things you absolutely must do first. This could be the most important financial decision you make. First things first, and I can't stress this enough, pay off your high-interest debt. I'm talking about credit card debt, personal loans, anything with an interest rate over, say, 7 or 8%. Think about it this way. When you pay off a credit card with a 20% interest rate, you are essentially giving yourself a guaranteed 20% return on your money. No stock market investment, not even the best ones, can guarantee you that kind of return. It's risk-free. Investing while you have this kind of debt is like trying to fill a bucket with water while there's a huge hole in the bottom. You're making progress, but you're losing so much along the way. So get aggressive. Make a plan, whether it's the snowball method or the avalanche method, and tackle that debt. Your future self will thank you for it. Once that's handled, you have a clean slate to start building real wealth. Next up, the non-negotiable, your emergency fund. Life is unpredictable. Your car breaks down, your pet gets sick, you lose your job. These things happen. An emergency fund is your financial safety net that catches you when you fall. Without it, you're one unexpected bill away from going right back into debt or, even worse, being forced to sell your investments at the worst possible time. How much do you need? A good rule of thumb is 3 to 6 months' worth of essential living expenses. That means rent or mortgage, utilities, groceries, and transportation. Calculate what that number is for you and start saving. Keep this money in a high-yield savings account. It's separate from your checking account, so you're not tempted to dip into it for a new pair of shoes. But it's still easily accessible when a real emergency strikes. Building this fund gives you peace of mind, and that is priceless. It's the foundation upon which your entire financial house is built. Don't skip this step. Okay, debt is being managed, your emergency fund is growing. Now let's talk about goals. Investing without a goal is like driving without a destination. You'll burn a lot of gas and end up somewhere you probably didn't want to be. So, what are you investing for? Is it for retirement in 30 years? Is it for a down payment on a house in 5 years? Maybe you want to save for your kids' education, or perhaps you just want to build wealth for financial independence. Each of these goals has a different timeline and a different risk profile. A retirement fund can handle more market ups and downs because it has decades to recover. A house down payment fund needs to be much more stable because you need that cash in the near future. Get specific. Write it down. How much do you need and by when? Having clear goals will determine your entire investment strategy. It tells you what kind of investments to choose and how much risk you can comfortably take on. Now we get to the part everyone talks about, understanding the basics. You don't need a PhD in economics, but you do need to know the difference between a stock, a bond, and a fund. A stock is a small piece of ownership in a single company. It can have high growth potential, but also high risk. A bond is essentially a loan you give to a government or a company, and they pay you interest. It's generally safer than stocks. And then you have funds like mutual funds or ETFs, which are baskets of many different stocks or bonds. For most of us starting out, funds are the way to go. Why? Diversification. Instead of putting all your eggs in one basket by buying one company's stock, you're spreading your risk across hundreds or even thousands of companies. This is the single most powerful tool for a new investor. Low-cost index funds that track the entire market, like an S&P 500 fund, are a fantastic starting point. They're simple, cheap, and have historically performed very well over the long term. Finally, let's talk about the secret weapon of every successful investor in their 20s and 30s, automation and consistency. The best investment strategy is the one you can stick with. The easiest way to do that? Put it on autopilot. Set up automatic transfers from your checking account to your investment account every single payday. It could be $50, it could be $500. The amount is less important than the habit. By investing a fixed amount regularly, you're doing something called dollar cost averaging. When the market is high, your money buys fewer shares. When the market is low, your money buys more shares. Over time, this smooths out the bumps and lowers your average cost. This strategy removes emotion from the equation. You're not trying to time the market, which is a loser's game. You're just consistently investing, month in and month out, rain or shine. This discipline, combined with the power of compound interest over the next few decades, is how real, sustainable wealth is built. It's not about finding the next hot stock. It's about timing the market, not timing the market, so let's recap the plan. 1. Attack your high-interest debt. 2. Build a 3 to 6 month emergency fund. 3. Define your financial goals. 4. Understand the basics and start with low-cost, diversified funds. And 5. Automate your investments and be consistent. If you follow these 5 steps, you will be in a far better position than 90% of people your age. You'll be building your financial future on a rock-solid foundation, not on sand. Investing can seem intimidating, but it doesn't have to be. It's about making smart, deliberate choices before you even put a single dollar into the market. You have the greatest asset on your side: time. Start with these steps, be patient, and let the power of compounding do the heavy lifting for you. You've got this. Thanks for watching. If you found this helpful, give it a like and subscribe for more straightforward financial advice. Let me know in the comments which step you're working on right now. See you in the next video.